Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Record highs, rate anxiety, and are robots taking over Wall Street? Welcome back to the Trending Report, where we break down what's moving markets, shaping the economy, and driving the conversations that you need to be having. We're talking about equity markets hitting new highs, but asking whether those highs are built on solid ground. Then we're diving into inflation because, spoiler alert, it's not done with us yet. And finally, we're turning the lens on artificial intelligence, the buzzword that just won't quit. Is the hype actually meeting reality? So let's get into it. So let's kick off things with the headline that's been dominating financial news this month. The stock market is at record highs. The S&P 500 and the NASDAQ both climbed to all new highs in late April and in early May. And on the surface, the story looks great. Corporate earnings for Q1 came in better than expected across the board. Companies are reporting solid revenues. Consumer spending has held up. And enthusiasm around artificial intelligence, which we'll get into a little bit later, is fueling a lot of the optimism in the tech sector. So what's the problem? Well, here's where things get interesting. When you look beneath the surface of the record highs, there are some things that are worth paying attention to. First, are valuations. So the forward price to earnings multiples on many of these stocks are sitting well above their long-term historical averages. What that means in plain English is investors are paying a premium price for future growth that hasn't happened yet. That's fine when everything is going smoothly, but it also means that the market becomes very sensitive to bad news. Whether that's a geopolitical shock, an inflation surprise, or an earnings miss. Second is sector rotation. We're seeing some investors quietly shifting money away from higher multiple growth stocks and towards more defensive plays. Energy, travel, consumer staples. That's a sign that sophisticated investors are hedging their bets, even while the headlines are screaming record highs. So, here's the takeaway. The market rally is real, and it's backed by genuine earning strength, but it's not bulletproof. The foundations are solid, but they're not indestructible. And in an environment where inflation, geopolitics, and interest rates are all still in flux, that distinction matters. The smart move is don't panic, but don't get complacent either. Stay diversified, keep an eye on valuations, and remember, all-time highs are exciting, but they're also exactly the moment when discipline matters most. Moving on to our second topic, and this one is going to affect pretty much everyone listening, whether you're an investor, a homeowner, a business owner, or just someone trying to manage a household budget. Inflation is back in the conversation. And if you thought we had put it behind us, well, May 2026 is here to remind us that it's not quite done yet. This isn't the same inflation story that we've lived through in 2022 and 2023. Back then, it was driven by a combination of pandemic supply chain disruptions, massive fiscal stimulus, and a red-hot consumer demand. That chapter has largely closed. What's driving the inflation pressure right now in 2026 is different. It's being led primarily by the energy prices. Short version is tensions in the Middle East, particularly around key oil shipping routes, have pushed crude oil prices sharply higher. And when oil prices go up, the ripple effects are felt everywhere. At the gas pump, in transportation costs, in manufacturing, food prices. It touches almost every corner of the economy. And that has real consequences. For anyone carrying variable rate debt, so credit cards, adjustable rate mortgages, business loans, the cost of borrowing stays elevated. For the housing market, affordability remains a challenge. And for investors who are counting on rate cuts to boost up bond prices and spark a new equity rally, well, that thought needs to be revisited. The big risk to watch is if energy prices stay elevated or climb even higher, inflation could be reaccelerated, and that would put the Fed in an even more difficult position. Bottom line, plan your finances like rates are going to stay higher for a while, whether that means paying down high interest rate debt, locking in a fixed rate where you can, or adjusting your investment portfolio for a higher for longer world. Now's that time to act with intention. And finally, what you've been hearing about constantly, and that's because it generally deserves the attention, is artificial intelligence. AI has been one of the most powerful economic and market forces of the last few years. And in 2026, it's absolutely still driving that conversation. From corporate boardrooms to central bank reports to your everyday news feed. But the conversation is shifting. And I think that shift is worth paying close attention to. So let's start with the positives, because there's a lot. AI is delivering real, measurable productivity gains across industries. Companies that have invested in AI-powered tools, whether that's in the software development, customer service, data analysis, financial modeling, or supply chain management, all are reporting genuine efficiency improvements. The technology is maturing and it's being deployed at scale. And it's showing up in earnings reports as a real driver of profitability for the companies that have done it well. From a market perspective, AI-related investments have been a major reason why tech companies have continued to perform strongly. The capital being poured into the AI infrastructure, whether it be data centers, semiconductors, cloud computing capacities, it's just enormous. And that spending is creating a whole ecosystem of winners. The chip manufacturers, the energy companies that are powering the data centers, software platforms, and beyond. But this is where the tone is starting to change. Investors and policymakers are beginning to ask some harder questions. Are the valuations justified? Some of the companies at the center of the AI boom are trading at extraordinary multiples. The market is pricing in enormous future earnings growth, but if that growth takes longer to materialize than expected, or if it's less transformative than the hype suggests, well, those valuations could face a reckoning. What's the return on investment? Companies have spent billions, in some cases hundreds of billions, on AI infrastructure and development. Investors are now starting to demand answers. Where's the revenue? Where's the profitability? How long before these investments pay off? The enthusiasm is still there, but the patience for vague promises is wearing really thin. So what about the risks? Regulations are advancing, governments around the world are working on AI governance frameworks, and questions around data privacy, intellectual property, algorithm bias, and economic displacement are becoming harder to ignore. There aren't necessarily reasons to avoid AI as an investment theme, but there are risks that need to be priced in too. Here's my take. AI is not in a bubble, but it's being priced like it's going to transform everything immediately. The reality is probably somewhere in the middle. AI will reshape industries. It will create enormous value, but that transformation will take time. It won't be linear, and it won't even, and not every company that claims to be an AI company will be the winner in that situation. The smart approach for investors is look beyond those buzzwords. Ask whether a company has a genuine AI advantage, better data, better talent, defensible moat, whatever it may be. Or are they just riding the wave of enthusiasm? So the differentiation between the real AI winners and the pretenders is going to become a much clearer over the next 12 to 24 months. And that brings us to the end of this month's episode of the Trending Report. The theme tying all of this together is resilience under pressure. The economy and markets are holding up, but the pressure is real, and how you position yourself in the environment matters. Until next time, stay informed, stay intentional, and keep trending forward.
Thanks again for listening to this episode of the Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.